Okay, class. Good afternoon, everyone. You're welcome to another class on strategic business reporting. Today, we are going to finish up on IAS 19 and also see if we can solve the questions or the assignment I gave you on IFRS 2. I also sent you additional assignment during the week, and some of you shared with me. For those of you that have not done it, you can do better. So let's move on for today. Last week, we started with IAS 19 on employee benefit. And I told you that employee benefits are all forms of consideration given by an employer to an employee for the services rendered by that employee. And we mentioned that these employee benefits, they could either be short-term employee benefits, they can be post-employment benefits, they can be other long-term benefits, and they can also be termination benefits. And we said our mission is to learn how to account for these categories of benefits. We started with short-term employee benefits, and I explained to you that these are benefits where the employee will get consideration within 1 year. So within 1 year of working for the employer, they will get their consideration. And typical examples are our wages and salaries. And how do you account for this? How do we account for short-term employee benefits? The key question is that when does the entity have an obligation? The entity that wants to account for these short-term employee benefits, when do they have an obligation? They will have an obligation immediately the employee has offered the service to them. Immediately the employee has worked for them, an obligation exists. So if it's a monthly payment of wages and salaries, then at the end of each month, as soon as the employee has worked for that month, we easily debit staff costs, then we credit accruals. Then when we pay, we just cancel out the accruals by debiting it, then credit bank. However, I said, if that consideration is paid, let's say quarterly, right? So if you are paying a consideration every quarter of 150K, you won't wait till the end of the quarter before you recognize that. Maybe at the end of every month, you are debiting staff costs and crediting accruals as the employee is working. Because at the end of each month, you have an obligation. You have an obligation because you must pay that employee. Now, for still on short-term employee benefits, I told you that we could have short-term paid absences where an employee is absent and we still go ahead and pay the employee like leave allowance or sick allowance. How do we account for such short-term paid absences? We said, first, it depends on whether that paid absences would accumulate or is non-accumulating. If it's going to accumulate, it means that even if the employee does not get that allowance, that paid absence this year, you can carry it forward to next year. So that means at the end of each year, the entity has an obligation because they will still pay it. But if it is non-accumulating paid absences, it means that they will only pay when the event occurs. They will only pay when the employee takes the leave. Okay, so in accounting for that, you would only account for a non-accumulating paid absence if the employee takes a leave. If the employee does not take the leave, it won't even pass your books because you won't have any obligation. But the one that is accumulating, you would have an obligation. because whether they take the leave or not, they can carry it forward to next year. So you just need to find out the details of how much you would have to pay when they take it. And that would represent our obligation for the year. We saw some examples. We saw this question on Plyman. I think it took us some time for most of you to get it. And I hope you have taken your time to look at it again. Then we went on to post-employment benefit. And we said these are benefits paid to an employee when they retire. A benefit paid to an employee when they retire. And these benefits, that means the employee will work for it for all his service years. It's a benefit they will work for all their service years. And when does the employer then have the obligation to pay this benefit? When do they have the obligation to pay? You know, immediately the employees start working every month, they have an obligation to pay. They have that obligation, just that it's the obligation will now, it will be gradual. It might not be everything, a portion of it periodically like that. So what employer usually do is that they know that retirement benefit is always huge. So they usually have plans, something we call plans. The standard IAS 19 says that these plans, we can either have a defined contribution plans or we can have defined benefits plan. I explained to you that for defined contribution plan, the employer makes regular contribution to a PFA periodically, and when the employee retires, they will just go and meet that PFA to get their money. Whatever the PFA does with the money, whether they're able to pay the employee or not, it is without recourse to the employer. It's none of the employer's business. He has no further obligation beyond making regular contribution. And the Nigerian Pension Reform Act requires the employer to do 10% and 8% by the employee. Jointly, 18% of total emoluments should be contributed monthly. And when the employee retires, they can go ahead and collect their money from that PFA, not the employer. The employer has no further obligation. So in accounting for a defined contribution plan, the major thing there, at the end of every month, you debit staff costs, you credit accruals. It could be pension expense, pension costs every month. When they pay, you credit that accruals, you debit bank. You debit the accruals, you credit bank, And we solved the past question. We solved the past question where they were supposed to be paying, I think 84 million. And we saw how they were overpaying and all of that. And that overpayment, we treated it as a prepayment. And the actual amount that they were supposed to pay was what went to P&L. So they could either overpay or underpay. Whatever it is, you treat those ones either as assets or liabilities. Then we went on to define benefit plan. For this one, I told you that the employer has promised an amount of benefit to the employee when they retire. And that's why they call it defined benefits. The benefit has been defined. In such cases, accounting for this one is much more difficult because the obligation the employer has is towards the benefits that will be paid in the future. Unlike defined contribution plan, where the obligation the employer has is just towards the contribution. So it's very straightforward to account for that. But defined benefit plan, the employer has to ensure that when the employee retires, he fully gets that benefit, fully. And that's a challenge, right? Challenge in the sense that how do we determine the monetary amount of the future benefit at retirement? Because the benefit might not come in form of, okay, we'll give you money. It could come in form of, okay, we'll provide housing for you. Okay, we'll pay your child's school fees. Okay, we'll ensure that you will get your final salary as your pension every month. It's not something direct. So it requires some kind of valuation, knowing how much the benefit would be. And when you know how much the benefit will be, you also need to calculate, okay, how much are we supposed to be contributing every month or every quarter, however it is. Nigerian law requires we do the contribution every month. So how much are we going to be contributing? Yes, we know that the Pension Reform Act says 1810, 10-8, 18% in total, but that might not be enough. So you really need to calculate and work out what the contribution would have to be in such a way that when you make those contributions, they will be sufficient to pay that benefit in the future. So it has there are a lot of assumptions that has to be made and all of that. It's actually complex. It's not accountant. We don't do that. I told you last week. We usually employ actuary to do that because they're experts in making all those assumptions and those valuations of those kind of financial assets and all of that. So they're good with that. But I told you that first thing you need to know when the actuary is engaged to help you do a valuation of your defined benefit plan, the first thing you need to really emphasize is this. You need to explain what we mean by projected unit credit method to them. And I told you that the way this works is that we need to work out how much we're going to be paying, the benefits, um, like the retirement benefits that the employee will get when they retire. We need to work it out on a yearly basis or on a monthly basis. You need to work it out like a unit method that you will be attaching units to each year the employee works for us. That way, if we do it like that, then it then aligns with the way we account for our transactions normally. Because in reporting, we use accrual basis of accounting. And accrual basis of accounting strictly aligns with economic activity every year that account for economic activity per year. Every year, what happened this year? Okay, let's record that as expense. Okay, how much money did we make this year? And that will be our income for the year. And that is why when you have rent, for example, you pay rent for 5 years, we won't carry all the 5 years rent and put it in our P&L this year. Probably would recognize only 1 year rent, then the other 4 years become prepayments. Even when I told you share-based payments, you saw that when we have an equity settled or cash settled share-based payment, where the employee will have to work for 5 years before the share options will vest, we saw the way it would spread those share option value over the period of service, right? So, and that's the way reporting works. So when the actuary wants to do his valuation, we need to ensure that it gives us annual value. And that's why these things are mostly done every year. Not necessarily that you have to do it year on year, but there are some organizations that would engage an actuary every year to give them these reports, every year. Now, what do we find in the actuary's reports? Number one is the current service cost. And the current service cost is, I told you, is similar to the annual pension expense. That, okay, you have worked for us this year. This is your pension you will get when you retire. So, and I gave you that, okay, let's assume that the actuary comes up with 100 million as current service costs. What that means is that this 100 million is like the present value of what you get when you retire for working for us in 1 year. So every year we need to determine this current service cost. current service cost. Okay, you have served us in this current year. Then, okay, you have earned 100 million for yourself. Not like he's going to get 100 million now. Like when you retire, you will get 100 million. So just imagine the person working 5 years. You know the multiplier effect, 100 every year, something like that. That's current service cost. And to account for that, when the actuary gives you this figure, first leg goes to P&L, second leg goes to PV of defined benefit obligation. P&L, PV of defined benefit obligation. So the PV of defined benefit obligation is the liability, and that's one we keep carrying forward every year. In fact, when the employee has worked for 10 years or 15 years, when you go to this PV of defined benefit obligation account, the balance there represents, okay, the obligation we owe to our employees. That's the obligation. Now, we will need to get this current service cost every year. In addition to current service costs, you also find contribution. So the actuary will work out how much you need to contribute every year, every month, however, just to ensure you're able to meet up or be able to pay that benefit when the employee retires. The way we account for whatever figure it gives us, we debit plan assets, we credit bank, because the contribution will be made into a plan asset, which could be a PFA, or an insurance plan, or stocks, or real estate investment. However, whatever it is, credit bank, because we actually pay it. Then the next one is the past service cost. And I told you last week that this past service cost is the change in the PV of defined benefit obligation as a result of an amendment or a curtailment. Change in obligation as a result of amendment or curtailment. I told you amendment is an introduction of a new plan or scheme. Curtailment is cancellation of existing plans, depending on what is happening to the company. I mean, if the company is doing so well, they're impressed with their staffs, I mean, they can come up with a new plan for employees when they retire. That's an amendment. And this will usually increase the obligation of the employer. But if the company is like shutting down some segments and some people have to be fired, but they're not doing so well. So some plans, some retirement plans they have before, they will have to probably maybe cancel it and say we are not doing it again. That's curtailment. Okay, that will also decrease, of course, the obligation. So that change in obligation is past service cost. So if it's an amendment, past service cost goes to P&L, then we credit the obligation, the PV of defined benefit obligation. If it's a curtailment, past service cost will go to P&L, but it's like an income because your obligation is decreasing. You debit PV or defined benefit obligation. Then benefit paid. I mean, when people retire, we pay them benefits. But since we have been planning for this, we simply take the benefit from our plan assets, which will also result in a reduction in our obligation. We can also have gain or loss on settlement, and this will arise when there is a curtailment, when there's a cancellation, when there's a shutdown. That's when we can have gain or loss on settlement, is when there is a curtailment. So whenever there is a curtailment, that the employer says, okay, I'm not doing this plan again, I want to close it out. That means they should be ready to settle. So they will agree a settlement price, which of course is from the plan assets. That, okay, for this closeout, for these people we're asking to go, would want to settle with 50 million. Of course, they know what the obligation would be. Let's say the obligation is, let's say 55. So they might not necessarily close out at 55. They can close out at, I told you 50 last week, which is a gain to them. That's like making a gain of 5 million. It goes automatically to POL. It goes straight to POL. Okay, so these were the items you'll find in the actuarial report. And I gave you this schedule last week also. That is extremely important. You will always do it in the exams. And which has plan assets, PV of DBU, and the nets. We'll give you the opening figures. You charge interest to unwind the discount. Any interest you charge on the opening plan assets is like an interest income. The interest you calculate on the opening defined benefit obligation is like an interest expense. Usually what goes into the book is the net interest, which is the net of these two. It goes into our books. Current service costs, you add it to the obligation. Contribution is added to assets. Past service costs is added or deducted from the obligation, depending on whether it's an amendment or a curtailment. Benefit paid is removed from the two because people are retiring. So we really need to go and take money from our plan assets wherever we have kept it. And also our obligation will definitely reduce. When there are curtailments, we would have gain or loss on settlement because we're actually going to be settling from our plan assets vis-a-vis reduction in our obligation. So if we're able to negotiate a deal whereby we are settling for less, we'll probably be making a gain. And it can be a loss also if we are settling more than our obligation. Basically, typically, this is what you would find at the most extreme part in your exams. When you accumulate these figures, you get carrying amounts. Okay. The examiner will always give you fair value at the end of the period of the plan asset and the obligation. They would always give you. And it is the net of these two, the net of this plan asset and obligation that goes to our statement of financial position. Also, you would also compare this valuation, carrying amount and the fair value. Okay, the difference between the carrying amount for plan asset and the fair value, carrying amount and fair value is usually the return on plan assets. While for obligation can either be gain or loss. I'll show you all this today when we solve questions. In your POL, what goes there are your net interests, current service costs, past service costs, and gain or loss on settlements. In OCI, return on plan assets, actuarial losses or gain, then in your statement of financial position, under non-current liability, when you get the net of this fair value, and your obligation happens to be higher than your assets, you would have a net defined benefit obligation, which is a deficit. If it's the reverse, you would have a net defined plan asset or surplus that goes under non-current assets. And I said today we are going to do asset ceiling. But before we go to asset ceiling, let's even solve questions on all of this. Then we'll round it up with asset ceiling. Okay, so let's start with this question. Let me solve this question, this question. Let me solve those two questions. Then I go to asset ceiling and I'll solve one question on asset ceiling. And I'll see if we can still solve more questions today. Okay. So let's start with this question. I'll really be glad even if any one of you could read. Is it possible? Anyone?
Which question, sir?
The one in front of you.
Okay. At January 1st, 2000 X2, the fair value of the asset of the defined benefit plan was valued at 1,100,000, and the present value of the defined benefit obligation was 1,350,000. On 31st December 2000 and X2, the plan received contribution from the employers of 490,000 and paid out benefit of 190,000. The current service cost for the year was 360,000, and a discount rate of 6% is to be applied to the net liability or asset. After these transactions, the fair value of the plan's assets at 31st December 20x2 was 1.5 million. The present value of the defined benefit obligation was 1,553,600 required. Calculate the gain or loss on remeasurement through OCI and the return on planned assets and instruct how this pension plan will be treated in the statement of profit or loss and other comprehensive income and statement of financial position for the year ended 31st December 20x2.
Ahmed, thank you very much. So you'll be reading for me, okay? So let's go. If you look at this question, let's focus on the requirements. The examiner is asking us to calculate the gains or losses on remeasurements through OCI and the return on plan assets. Okay. And they say we should illustrate how the pension plan will show in the statement of profit or loss and other comprehensive income, and also in the statement of financial position as at 34 December 2002. So the first thing for us is that table I told you about. That table I told you about. So where you have plan assets and you have PV of DBO. You know what DBO is? Defined benefit obligation. And we have net. So okay. So we start with the balance brought forward. Ufama, go ahead. You have a question.
So good afternoon.
Hi. Hi, I can hear
Sir,
you.
can you hear me? Good afternoon, sir.
Yes, good afternoon.
Hi, thank you. This format, this is how we're going to follow it in exam, this format.
Yeah, I guess so. This is how you follow it. Just pay attention to it, but I've not even solved any question. This is the first one we're solving, okay? Okay. If you look at this first and second paragraph, the examiner already gave us all the details you need. If you look at it, they said at the beginning of the year, they gave us the fair value of assets to be 1.1. They give you the PV of defined benefit obligation as 1.2. So they gave me 1.1, and they also gave me 1.2. So there's a net of how much? What's the difference? Is that not 150? So in this case now, the obligation is higher. That's like a deficit. So let me put it net. But the reality is I don't really need nets here because this is opening. But at least I've captured this amount. Now, the next one you must immediately do in the exam, because if you don't do it immediately, you will forget, because they won't give you directly in the question. And that's this interest, because using this discount rate that they give us, using this discount rate that they give us. So interest at 6%. If I may ask you, because I'm just saying this because none of you is asking, yes, we'll teach you very well. You guys will pass your exams. Your exams will be like a walkover for you because we'll have taught you mostly everything you find there. But in addition to that now, let's assume, is there anybody here that your office use a defined benefit of plan? It's mostly scarce, but I mean, I've seen several entities that use it. Okay. You know that in real life, there won't be any question that will give you, these rates. Yes, the examiner is giving you now, fine. In real life, where do you get these rates? Can anybody share that with us? Where do you think we can get these rates in real life? Nobody? Okay, so that won't waste our time. These assets, when you check the PFA or the Pension Reform Act, it has prescribed where this PFA can invest this money. So usually they invest in highly risk-free investments. Now I think they just amended it, allowing them to invest in stocks and all of that. Before they restricted it so well that they only invest in risk-free, high return, right? In fact, for my company, I use Stanbic IPTC. So every month they are sending me my account balance. So they sent me an account balance last month. When they were going to send me the account balance this month, I saw that without even contributing, it has grown by almost 1 million. So that means they are investing and making so much money, and the growth is affecting everybody. The reality is this: in real life, these rates, you need to look for maybe corporate bonds that is high yielding. Corporate bonds that are high yielding. Where would you get that? I mean, if you go to FMDQ websites, there are listed debt securities there, both government and corporate bonds. Maybe commercial paper, but commercial paper rates are very low. So high yield corporate bonds, the average rate there, you can use this to determine your interest in real life. Okay. But I mean, not to bother, exams are always easy. So they will give you everything you need. Just do a simple table and get marks. So what's 6% of 1.1 million? That would be 66,000, right? So what would be the 6% of 1,250,000? I really need you to give me figures so that we won't spend so much time on this. So what's 6% of 1,250?
75,000.
75,000.
75,000. I told you that what we need is the net. So the net is 90, that's 9,000 because the liability is higher. Let's put it in jackets. This one is higher. Put it in jacket. Okay, so immediately you have sorted that out, then you go back to your question. So we have captured up to this point. So they said on December 2002, the plan received a contribution of 490, paid out benefit of 190. Okay, so let's address those two. The plan received a contribution of 490. Now, where do we put contributions? Will it increase our asset or decrease our obligation? Where did I tell you it goes to? Anybody? Thank you very much. It's going to increase our plan asset. In fact, that's what make our plan asset contribution. And they said we also paid out benefit paid. I told you that benefit paid will be taken out from the plan assets and will automatically also reduce our obligation as well. So it reduces both ends. Okay. Then the next one is the current service cost. Current service cost. And the current service cost is the obligation we have for the employer for working for us this year. It's like the annual pension expense, as far as we are concerned, is what actually makes up the obligation. So to be added to the obligation, current service cost is usually added towards the obligation. Okay, so, and that's all. That's everything here. That's everything. I'm still coming back to this fair value they give me at the end of the year. I'm still coming back to that. Just follow me through. Now, what's the balance at the end of the year? I like to write it as carrying amount, so it's easily comparable. You can put it as balance growth carried forward if you wish, but so can you cumulate these figures on that plan asset for me, please?
1,466,000.
Thank you, Charity. 1,466,000. How much goes under DBO?
1,495,000.
1,495,000. Okay. Now, they will now give you fair value. They'll give us fair value. And that will be given usually anyway. So, but they give us at the end of the paragraph here. So they give us the fair value of the plan assets. They give us as how much? 1.5 million. So that's 1.5 million. They also gave us the fair value of the PV of the DBO as 155,360. Okay, so they will usually give you that. Okay. Now, what do you then do with this? Number one, what goes into the statement of financial position is usually the net of these two. The net of these two. In this case, the obligation is higher than the assets. Therefore, we'll have a net defined benefit obligation or a deficit of, I think, 53,600. Yeah, 3,600. This one will go to statement of financial position under liabilities. Additionally, this fair value that they gave us for the asset and liability would also get to look at changes in value. We also get to look at changes in value because if you look at our plan assets, based on what we recorded in our books, it was 1,466. But the actuary came and said that no, that the value of your plan asset is actually higher than what you have in your books. It should be 1.5 million. That's like a gain to us. It's a gain. So we'll have what we call return on plan assets. I mean, for plan assets, whether it's a gain or loss, it's still called return on plan asset. And it usually finds its way into OCI. So what's the difference between these two guys? I guess that should be 34,000. Yes, 34,000 for the asset. For the PV of DBO, you would also compare your book value from this table with the fair value given to us. You will see that the fair value of the obligation is higher than our book value. Is that good or bad? I mean, let's analyze it. When my book is saying that I owe 1.4 million, the actuary came and said that I actually owe more, that what I'm owing is higher than what I have in my books. That's not a good news. That's a bad news, that I'm owing more. That is an actuarial loss for me. That's an actuarial loss. He says, I'm owing more. My book is saying I'm owing 1,495. And you are coming to say that the fair value of the obligation is 1.5 million. That's a bad news. I'm owing more. So we call that actuarial loss. It goes to OCI. The reverse will be a gain. If, for example, instead of saying I owe 1.5 million based on his own valuation, he comes in and said I owe 1.3 million. That's good. That would be an actuarial gain. Okay? But in this case, it is an actuarial loss because he's saying I'm owing more. Bad news. It's a loss, it's an actuarial loss. I'm owing more on the basis of what we have here. And what's the difference? What difference do we have?
58,600.
58,600. Okay, and we're able to do this successfully, then you are done with the first part of the question. And this calculate actuarial gains and losses on remeasurement and the return on plan assets. So I've done that already. You see, there's no way you will have done that if you don't do this. Let me even put this in jacket since his obligation was higher. Then, now let's prepare our statements. So my statement of profit or loss for the year ended, when now? 31st December 20S2. What goes to P&L? Number one is my net interest. It goes to P&L. In this case, it's a net interest expense because when you look at this interest expense here, the obligation was higher than the asset. So it's a net interest expense. And we have it here as how much? 9,000. Contribution, no. Benefit, no. Then we have current service costs. Current service cost. How much is it? 360. And just putting them in jackets just to show that they are expenses. That's why I'm putting them in jacket. And that's it for that. In my statement of other comprehensive income, for the year ended as well, so I can just copy it here. So what goes to my OCI, I told you already, the return on plan assets, which we got up there as 34,000, this one. And also actuarial loss, which we got as 58,600. I'll put that in jacket to show that it is a loss. Finally, I'll do my statement of financial position as at year ended 31st December 2002. So I told you that what you put there is the net of these two. And since the obligation is higher, that will show under non-current liabilities. Non-current liabilities. You call it net defined benefits obligation, or you can simply call it deficits. And it was how much? 53,600. 53,600. And that's the end of this question. Any questions? Any questions? No questions? Okay.
But please scroll up. Yeah, it's okay. So why are we not balancing it?
It's an
Like
extract.
okay.
Balance extracts. Like you want a certain financial position to balance. Is that what you mean?
So like the PRL, we didn't get the balance. The
Accumulation of
OCI,
loss.
yes.
No, it's not necessary. It's just an extract.
All right.
Yeah. I'm sure you have your notes. It's either you're writing, I don't know what you're doing. You know what you'll be doing, but anyway, I will still share this with you, but you should be in a class situation, jotting and doing all of that right now. Let's have another question. Ahmed, please read.
Yes, sir.
Please read.
Okay, sir. For the sake of simplicity, and clarity, all transactions are assumed to occur at the year end. The following data applies to the post-employment development benefit compensation scheme. of BCD company. Discounting rate 10% each year. Present value of obligation at start of 20x 1 million. Market value of planned asset at start of 20x 1 million. The following figures are relevant. Current service cost 2000 and X2, 2000 and X3, 2000 and X4. Benefit plan, benefit payout, contribution paid by entity, present value of obligation at year end, fair value of planned assets at year end. Assume all figures correct. Additional information. Number one, at the end of 20X3, a division of the company was sold. As a result of this, a large number of the employees of that division opted to transfer their accumulated pension entitlements to their new employer's plan. Assets with a fair value of 48,000 were transferred to the other company's plan, and the actuary has calculated that the reduction in BCD's defined benefit liability is 50 million. The year-ended valuation in the table above were carried out before this transfer was recorded. Number two, at the end of 20X4, a decision was taken to make one-off additional payments to former employees currently receive pensions from the plan. This was announced to the former employee before the year end. This payment was not allowed for in the original term of the scheme. The actual valuation of the obligation in the table above includes the additional liability of 40,000 relating to the additional payment required. Show how the reporting entity should account for the defined benefit plan in each of the years 2000 and X2, 2000 and X3, and 2000 and X4.
Thank you very much, Ahmed.
Yes, sir.
So let us look at it. You said show how the reporting entity should account for this defined benefit plan in each of the years. Okay. So let's begin one by one. Again, if you look at the very first part of the question, they give us the discount rates, usually to calculate the interest. They give us the PV of obligation at the beginning of the year. They give us the market value of the plan asset at the beginning of the year. So let's execute those first. So let's say this is 2022. Of course, I will have my plan assets. I will have my PV of DBO, and I have the net. Then let me put it this way, the level of rounding up. Okay, the balance at the beginning, the examiner gave me 1 million for obligation, 1 million for asset. So I'll write the 1 million this way and the 1 million this way. Then, and so that I won't forget, I'll immediately take care of my interest. Interest at 10%, because the examiner gave me the discount rates. The discount rate at 10% each year. So interest. So 10% of 1,000, that will definitely be 100. 10% of this 100, so they nil off, so nothing goes to POL because the same figure, 100, 100. Then, moving forward, they gave me current service costs, benefit paid, contribution paid, PV at the end, fair value at the end. Let me quickly deal with those. The first thing they gave me here was current service cost. So my current service cost in 2002 is 140. So where are we going to take current service costs? This
PV
140
of
is,
DBO.
PV of DBO.
thank you, and that's 140. Then benefit paid out, 120. Where would this one go to?
PV of DBO.
We left it from both.
Good. And how much is it? 120. We'll move it from the two. Benefit paid. It will be removed from the asset. It will be removed from the obligation as well. That's the benefit paid. Contribution paid of 110. Where will it go to?
Assets.
Correct. We'll add it to plan assets. That's where we are contributing to. Then they gave us the fair values. Okay, we'll come to that. And the additional information given to us was about 2023 and 2024. So when I get to that year, I will deal with that. Okay. So first, let me get the book value at the end. So can you cumulate this for me? If we cumulate the plan asset, what do we have?
1,090 naira.
Okay. How about the DBO?
1,120.
Okay. The fair value given to us in 2002, obligation 1 to assets 1 to 50. So assets was given 1 to 50, obligation 1 to. So the difference is how much? 50. And in this case now the asset is higher. So this becomes a surplus or a net defined benefit asset. So let's get the difference between the two. For the asset first, this one is higher. The fair value is higher than the book value, which is a gain. So we call that return on plan assets. So what's the difference?
160.
160. For this one, the obligation is also higher than the book value. Is that an actuarial loss or an actuarial gain?
Actual gain.
Actuarial loss.
It's a loss. I mean, the way you should, I don't know how you want to interpret it, but I mean, anything that makes me owe more is a loss. My book is saying I owe 1120, and the actuary is now coming and saying that I owe 1.2. I mean, my initial reaction will be, what? What? I won't be happy about that. It's a loss. It's an increase in obligation. So nobody wants that. Okay, so that's for
Is it
2000.
not 120?
Share this one.
Is it not 120, sir?
Okay, the difference.
Yes, sir.
Can you punch your calculator? Let's see if it's 120. Why not? We change it to 120. But what I'm seeing here is 80, being the difference.
It's 80, sir.
Yeah.
It's 80.
I'm like, how did we get it? I'm confused.
Oh, okay. 1,200 minus 120.
Oh. Thank you, sir.
You're welcome. So it's just the same way like we got this 160. It's 1,250 minus 1,090. Okay. In 2003, just so that I'm just changing only figures, let me just copy and paste this. Okay. Okay. So you know that the balance at the end of 2002, you know, it will become the balance at the beginning of 2003. Is there anybody that don't agree with that? That the balance at the end, and it's fair value, because it's the fair value that goes to our books. The balance at the end of 2002 becomes the opening balance of 2003. Okay, so that's sorted first. Then we calculate our interest at 10%. This will be 125, right? And this will be 120, right? Then there's a difference of 5. Good enough. The asset is higher than the liability. So this becomes a net interest income to be positive in our P&L. Then our current service cost in 23 is actually 150. So we already agreed that current service cost should go to DBO, 150. Benefits paid in 2003 is 140. We already agreed that benefit paid will be taken out from the 2. So 140. Then contribution paid is 120 in 2003. We already agreed that contribution paid should be added to plan asset. So there's this additional information they give us in 2003. Oh, okay. Charity, you said I'm very fast. Oh, okay, sorry. I thought because I'm just doing the same thing over again. That's why. Okay. Hold on. Hope I was not changing the wrong thing. This tool that I changed last I was changing the wrong thing. Okay, I was changing 2019 or 2003. So let me start from benefit paid. Benefit paid is 140. So we already know that benefits will be taken out from assets and it's also going to be taken out from liability. So we'll take it out from the 2. Current service cost, we already mentioned that. That's 150. Okay, I also need this is supposed to be 140. Current service costs is 150. Current service cost. Okay, and we already know that that should be added to our PV of DBO. And contribution, we already know that contribution is 120 in 2003. So similar to what we have done before, this should be added to the plan asset. Okay. And there's no need to put the net. It's only this one that we need the nets because the standard says you put the net to P&L, the interest. Okay. So in 2003, I can see that there was an information given to us. So let's look at it together. So at the end of 2003, a division of the company was sold. As a result of this, a large number of employees of that division opted to transfer the accumulated pension entitlements to their new employer's plan. Assets with a fair value of 48 million were transferred to the other company's plan, and the actuary has calculated that the reduction in BCD's defined benefit liability is 50,000. The end valuations in the above were carried out before this transfer was recorded. Okay, let's look at this closely again. So from what I can see here, right, this company sold a division. So because of that, of course, employee will have to go. So they say they want to transfer their pension to another plan. Now, that their pension, we have contributed a total sum of 48,000. Okay. So assets with a fair value of 48,000 will be transferred to that plan. And the actuary calculated that our obligation will reduce by 50,000. So how do we treat this? The way we treat it is quite straightforward, because from what I'm seeing here, I can see a curtailment. There's a curtailment. And I told you that when we have curtailments would result in what we call settlements, because this company had to sell a division and people have to go. So they had to settle. So in the process of settling, the settlement price from here is 48,000, because they say asset to the fair value were transferred to other plans. So they will take 48,000 from here. Then the liability reduced by 50. So let's quickly capture that. This curtailment slash settlement. So the plan assets, no, I'm not supposed to put it here now. In fact, let me just cancel it to this point. So curtailment slash settlement. So the plan assets that was transferred is how much? It's 48,000. And we're told that our obligation will reduce by how much? By 50,000. So there's a difference of 2. Who can tell me, what do we call this 2? What do you call this 2?
Let me try.
Okay.
I think it's a gain on settlement.
Fantastic. Fantastic. That's absolutely correct. So why a gain and not a loss?
Because a higher amount of the obligation was, like, the obligation was, a higher amount was reduced. How do I put it? Like 2 million. They're supposed to pay out 2 million, but they eventually paid they're supposed to pay out 50, but they eventually paid 48. So that 2 million difference was a gain to them.
Correct. Absolutely correct. Okay, nice one. Very nice one. Okay. So, and that's that. It's not more than that. So let's close it. Let us close it. So carrying amount. So can you cumulate it for me, please?
Plan asset is 1,307. 307, yeah.
Okay. How about this? How much is the obligation?
1,280.
1,280.
Thank you. Okay. Now, there's something you would omit. Most of you might omit in the exam. This one. They said the year-end valuations in the table above were carried out before this transfer were recorded. So, meaning in year 3. And this transfer they are talking about is this 48 and 50 that we deducted here in determining this carrying amount. They said that the valuation they gave us here, this 1,650 and 1,450, they said this valuation were carried out before this transfer was recorded. So that means they haven't transferred the assets, they haven't reduced the obligation. So by these respective amounts, which we have to do. How do we get that done? So meaning that the fair value we have for assets, the fair value is 1,450. 1,450. That means we need to remove this 48 because they say it has not been removed, the transfer. So that would leave me at 1,402. The same thing, the obligation, this 1,650, we need to remove this 50 also from this valuation as well.
1,600.
That leaves me to 1,600. So what's the difference between this fair value? That should be 198. And the obligation is higher, so jackets. Who can tell me, what do we call this 198?
Sir, deficit.
Thank you very much. Deficits or net defined benefit obligation. Correct. Absolutely correct. So now the plan assets at the end is higher than our carrying amount. That's a gain. So we have return on plan assets. What's the difference? Oh,
95.
95. The obligation at the end is higher than the obligation in our books. Is that a loss or a gain?
Again, sir. Actual gain.
Is a loss. Is a loss. Who can tell me why it's a loss?
It's a loss.
Why is it a loss?
The balance at fair value is higher than the one at carrying amount.
Okay, yes. So how does that explain the loss?
I don't know.
Because your obligation becomes higher. You have an higher obligation. You have more debts. That's not good for you. When your obligation becomes higher, that's an increased obligation, and that's a loss. That's a complete loss. Okay, let's do 2004. Let's do 2004. So the balance at the end of 2003 becomes the opening for 2004. Okay. Then I will immediately also deal with my interest at 10%. So let's say this is 140. This is 160. This is 140.2. So this will be around 19.8. My net interest expense. Michael, you have a question?
Sir, hello, sir.
Yes, Michael.
Okay, yes, sir. I am at work now, and it's like I'm running the two together, so I'm not concentrating. I don't know if we will have this video tonight, so I can study in the midnight, sir. Are you releasing this video tonight for us, sir?
Okay, I'll try my best to make that happen. I don't know, because
Okay,
after
please,
your
sir.
class, I'm still having another class again. So like 7.
No, we are not having another class. We professional are not having another class again.
Me, I'm
So till
having another
tomorrow.
class.
Okay,
Mm.
you're having another class. Okay, okay, okay.
I'll
No
see what I
problem, sir.
can do.
But thank you very much, sir. Because I want to leave the class now, sir.
Why?
Because I'm not concentrating on either of the two, sir. They are calling me here. I'm trying to concentrate here. So at the end of the day, I'm
Oh,
divided
okay.
attention.
You're at work.
Yes, I'm at work, sir. Yes, sir.
Oh, okay, okay. No problem. We'll upload it today, don't worry.
Thank you very much, sir. All right. Thank you, sir.
Right. All the best.
Amen, sir. Thank you.
Okay. So, yeah. So as we were saying, so we have 19.8. That's the difference. Then we have our current service cost in 2004. Our current service cost remains 150. Where would this one go?
PV of
PV
DBO.
of DBO.
Thank you. Then we have benefit paid out, 150. Where will this one go?
We'll let it from the boat.
Okay, I can see that is Charity that is always telling us this one. We let's see from the boat, like every time. Okay, the next one is contribution, which is 120. Where will this one go?
Plan assets.
Correct. Now you told us another one. Not again. Okay, that's all. So there is an additional information for 2004. Let's look at it. So it says at the end of 2004, a decision was taken to make a one-off additional payment to former employees currently receiving pension from the plan. This was announced to the former employees before the year end. This payment was not allowed for in the original terms of the scheme. The actuarial valuation of the obligation in the table already includes this additional liability. Okay, so what is this actually talking about? Let's look at it very well. A decision was taken to make a one-off payment to former employees currently receiving pension. So they announced it before the year end. The payment was not in the original terms, and the valuation that the actuary gave to us already includes this 40,000. And okay, in this their value, Okay. So what's this talking about? What's this 40,000? Can anybody help?
Looks like is there amendment?
That's absolutely correct. It is an amendment. So, okay, if it's an amendment, then If you remember, where is it? Where is it? Yeah, past service costs. I say past service cost is a change in PV of defined benefit obligation as a result of an amendment or a curtailment. So that means this is actually a past service cost because it's resulting from an amendment. It's coming up from an amendment. Therefore, it's a past service cost because what they are doing is there is an additional payment to former employees. Is an additional plan to them. So when there is a change in obligation as a result of an amendment, then that's a past service cost. So this 40,000 is a past service cost. So you're absolutely correct among me. So where does this past service cost go to? Plan assets or obligation?
Obligation.
Thank you. 40 obligation. So we're done. So let's get our carrying amount. So how much is our carrying amount? Who gives us the figure?
That this amendment, why are we not lessening it?
It has to be added because is an additional contribution. Is an additional payment. Is amendment should be added to the obligation. Is an increase in the obligation. So if it were to be a past service cost as a result of a curtailment, then that's when we'll less. But this is an amendment. Our obligation increased. So you add it to your obligation. That is why we have to add it.
Thank you, sir.
You're welcome. And you also ask, how do we determine curtailment, right? Do you get that now?
No, like, it's not how we determine, like, how do we identify it? Like, if a question is given to us, how do I know that this scenario is curtailment?
I mean, it's either they have shut down the division or they sold the division and people have to leave. That's a curtailment, like a shutdown or a cancellation of a plan or the
Thank you,
shutdown
sir.
of business. Yeah. Okay. Who can give us the carrying amount?
1512.2.
Okay. What about
One
the
eight.
okay? Now let's get the fair value. The fair value for the obligation is 17. The asset is 1610. So assets 1610. And this is 17. What's the difference?
90.
What do we call this 90?
Surplus, sir.
Return on plan assets. No, sorry.
Loss, sir, is
Sorry.
deficit, sir.
Deficit.
Yeah. Deficit. What's the under name for deficit?
Um,
Loss.
Net defined obligation cost.
Net defined benefit obligation. You tried. Okay. Now, for the asset, our asset increased. The fair value of the asset increased. That's a gain. So we have return on plan assets. What's the difference? Oh yeah. What's the difference?
97.8.
97.8. This one, our obligation decreased. The fair value is lower. Is that an actual gain or actual loss?
Gain.
Yeah, finally. It's a gain because our obligation is decreasing. Okay, so that's all. So let's prepare our statement. Statement of profit or loss for the year ended 2002, 2003, 2004. So my current service costs, I can see immediately 2003 is 150, 2004 150, 2003 120, 2002, how much my current service cost? 140. Okay, I must not forget my net interest expense, net interest expense or income. 2002 was nil. I can remember that very well. This one was a net interest expense because the obligation was actually higher. So 19.8. I need to put this one also in jacket because it's also an expense as well.
Hello. Then there's a
Mom,
mix up. The current service cost for 2003, it's 150.
oh, okay.
Am I mixing it up?
Current service cost, yeah, it's 150. How about 2004? It's 150 as
2004,
well.
152. Yeah,
How about 2002?
it's correct.
Okay,
140.
thank you. So what's the net interest expense for 2003? It's 5. Abi? And this one is not even expense, it's a net interest income because the asset side is higher than the liability side. So it won't be in jackets. 5. Which other one?
Past service cost.
Yep, past service costs. How much? This one, 40 in 2024. Expense. Which one again? Don't let us forget gain on settlements that happened in 2003. This one, these two, 2003. I guess that's all. So statement of other comprehensive income for the year ended 2002, 2003, 2004. So I have return on plan assets. I have actual loss, and I can have actual gain. In 2004, we had a gain. I had a gain of 100. This one. In 2003, we had a loss of 320. We had a loss of 320. Okay, and even in 2004, there was a return on plan asset also of 97.8. Even in 2003, there was a return on plan asset of 95. And in 2002, actual loss of 80, return on plan asset of how much? 160. General loss of 80, total plan asset of 160. Okay. Then my statement of financial position.
Sorry, sir. The actual loss on 2003 is 320, not 329.
Oh, okay, thank you. Okay. Okay. So in 2002, the asset was higher. So we actually have a net defined benefit asset or a surplus in 2002. So that will show under my non-current assets. Net defined benefit assets or surplus. What do we call it? 50, Adi? It was 15. Yep, 15. Then in 2003, it was a net defined benefit obligation because the obligation was higher than the assets of 198. That will show under my non-current liabilities. That's my net defined benefits obligation or deficits, 198. And in 20x4, it was also a net defined benefit obligation of 90. So still be here as well. And that is the end of this question. So this question is just practice this one. I mean, it cleans out a lot of things for you. It goes a long way to help you because it's 3 years. You get to practice a lot of questions like that. So what's our time? Oh, time is almost up. Even though I started very late today. Let me quickly explain asset ceiling. So you see, when we say asset ceiling would happen where we have this will occur. This will occur where we have a net defined benefit assets or a surplus. That's where we would start talking about asset ceiling. And which one? Like this 2002 now, where after we did all our workings, we're now having a net defined benefit asset or a surplus. So there's something we call asset ceiling, okay? And what this is talking about is that, so this asset ceiling is to ensure that the surplus that is recognized is not overstated. That is, it should not be higher than the actual savings, Okay, so what's then the actual savings? When we say what asset ceiling is saying is that, okay, this surplus that you say you have, that your plan asset is higher than your obligation. Like I showed you in this 2002, our plan asset is higher than our obligation by 50. And we went ahead to recognize that 50. You see, in reporting, we're always very careful when recognizing assets because we hate to overstate our assets. When you put an asset in your books as 50, like we did here, what it means is that you're expecting a return of 50. You're expecting something worth 50. So in this scenario, right, where the way this 50 was determined is by comparing a plan asset to an obligation, you now got 50. Don't just put 50 in your books for putting sake. Can you actually get 50 back? Okay, because, and how can you get 50 back? I mean, hypothetically in this case, two ways, right? Is either you get a refund, because for your plan asset to be higher than obligation, it probably means you have contributed a lot of money into that plan, that it is now higher than your obligation. So is either you're expecting a refund or there will be reduction in future contributions. So they can tell you that, okay, in the future, instead of contributing this so much you are contributing now, the actuary might say, okay, maybe you should reduce it by a certain amount. I mean, those are savings. So if that would happen, then asset ceiling is saying that we need to get that. And that is what we should recognize as assets. So if your actual savings is, let's say, 25, so we are saying don't recognize 50, recognize 25, because that is what you are expecting as return. That is what you are expecting as savings. That is what you will get benefit from. That's the benefit you will get, which is what an asset is. And that's what asset ceiling is looking at. It's just trying to say that don't overstate this your surplus, right? The examiner will give you an indication of an actual savings, and that is what should be recognized in place of this. But you know that if instead of recognizing 50, the examiner says, no, the actual savings you make from this is actually, let's say, 40, and you change it to 40. In reporting, you don't just change, you will pass double entry. You will pass double entry. You see, that difference of 10, because if it's an asset, it's like you are crediting the asset. Okay, to bring it down, do you know what you're debiting? OCI, because it's a remeasurement. So remeasurement from asset ceiling goes to OCI also. So that difference you're capturing has to be settled in the statement of other comprehensive income. So that's what asset ceiling is all about. There's a question we can use to practice that, which is this. So let's look at this question. This question says, Apolline Co. manages a defined benefit scheme for its employees. Okay, at 1 January 2008, the fair value of the scheme is 137 million. The present value of the scheme is 122 million. That is the present value of the obligation, of the scheme liabilities. So asset ceiling has been calculated as 4 million. So discount rate on high quality corporate bonds. I remember, okay, this one is a very expressive correction. I remember I told you that practically the way you get this discount rate is looking at corporate bonds that are high yielding, something like this. They told us in this correction. So the following are details of the scheme. So they give us contribution, benefits, current service costs. Okay. Then I said at the end of the year, asset ceiling is now 11 million. So during the year, there was a scheme curtailment resulting in a gain on settlement of 3 million. Immediately after the scheme curtailment, they value the asset as 148 liability. Okay, almost similar to what we have been doing so far. So how do we do this? So the same thing, we do our plan assets, we do our PV of DBO, Then we do the net. So the balance at the beginning, what's the balance go forward? For the scheme assets, 137. For the scheme liabilities, 122. Okay. This time around, I think I might need a difference in order to get the net. Yeah. So what's the difference?
15 million.
15 million. However, I can see that they said the asset ceiling is 4 million. So that means you will see that the asset was higher than the liability. So ordinarily, we should have gone to recognize this. They will have recognized this 115, 15 in their books as net defined benefit asset. But since they say the actual savings, the asset ceiling is 4. So that means we need to put there'll be like a ceiling adjustment of like 11 in such a way that what will go into our books must be what? 4. That's what we're going to recognize in our books. 4 million. So the interest now, why I'm doing all of this is just because of this interest. Because I really need the net for this interest. Okay, Amomi.
Yes, sir. Kindly re-explain this ceiling adjustment. I didn't get that. I didn't
Okay,
get.
all right. So, not so different from what we have been doing so far, other than the fact that the actual savings here is 4 million. So, ordinarily, I would have not even done the net for opening. But for the fact that the examiner told me that the opening asset ceiling is 4 million. So instead of this 15, okay, what we would have to recognize is actually 4 opening. So this 11 million you're seeing here, just the difference between 15 minus 4. It's like there's a decrease by 11 to come to 4. So it's just 15 minus 4 to arrive at this ceiling adjustment. Did I help? I don't know.
Yeah, thanks.
Okay, so interest at 4%. Instead of doing it separately, what I need is actually the one on this ceiling adjustments, but I will need everything too, because by the time I'm accumulating all of this. So let me get 4% of 137. How much?
5.48.
4% of 122. How much? Oh God, people are not giving figures in this class. They're just wasting our time.
6.1.
4.88. Can you hear me?
Okay, is it this one?
No, the second one. The first one is correct.
How about the second one?
4.88.
Okay, so what's the difference?
0.6.
0.6.
Okay, so what's 4% of this 11 too?
0.44.
So what's 4% of this one?
0.1.
Okay, so which one goes to P&L? You know, the one I've been doing so far, I will just take this net to P&L. And since the asset is higher, I will call it a net defined, a net interest income as positive in P&L. But because of this asset ceiling, that reduce the value of the asset to 4. So what will go to my P&L is actually this 0.16. Is this 0.16 that goes to my P&L? Okay, that being settled, then contributions. My contributions is to my plan assets. My benefits paid, like what charity always say, remove from both. So let's remove from both. Then we have current service costs. We'll add it to obligation. We add it to obligation. And at the end of the year now, they say asset ceiling is 11. I'll come back to this. This asset ceiling 11. So there was a scheme curtailment resulting in a settlement of, wow, they already gave us the gain on settlement of 3 million, no problem. So curtailment, so and when there's a curtailment, that means they need to settle people. So in this case, they gave me the gain directly as 3, right? Giving me the gain directly as 3 shows me that which one will have been higher, obligation or asset?
Assets.
Asset.
Assets will have been higher. Gain. No, now.
No, obligation will be higher.
Yes, now obligation will have been higher by that 3. Obligation will have been higher by that 3. So if you remember, there was one we solved. Where is it? This one. This one. That we had a gain on settlements. You will see that the obligation was 50. The asset was 48. So an asset, an obligation of 50, we settled it for just 48. So we are making a gain of 2. So year 2, since they just gave us gain directly, it means that the obligation will have been higher by 3. So it's important you do this, otherwise your account will not, you will miss one mark or the other. It's very important you actually present it this way. You put 3 being higher, and this one's 0, just so that you are getting that gain of 3 given directly in the question. And you see that I'm lessening it because the curtailment, obligation will reduce, assets will reduce, right? And I mean, that's pretty everything. Okay, so let's close out. So can you get me the carrying amount?
What about the last paragraph?
The fair value, share this one.
Where we have immediately after the scheme, the hotel value, the scheme
The
asset
asset
have
ceiling. The asset
148.
ceiling. This one, the 148 and 136.
Yes.
Those are the fair value. I'll get to that now. After my carrying
Oh,
amount, I will just
okay.
those are my fair value. So how much is the carrying amount?
$143.48.
What's the DBO? How much is the DBO?
122.88.
122.88. Now, what's my fair value? So fair value of the asset is 148. Fair value of the liability is how much? 136. So the difference should be 12. Abi? This
Yes.
4, yeah, 12. But they told us that at the end of the year, that the asset ceiling is actually 11. That instead of recognizing 12 as net defined benefit assets, you say we should recognize what? 11. So there will be a ceiling adjustment of how much?
1.
1. Now, having done that, you will see that our asset is higher at the end. So that's a gain of how much? Return on plan assets. How much is that?
4.52.
4.52.
And also, the obligation is higher than the assets. Is that an actual gain or an actual loss? The obligation is, fair value of the obligation is higher than the book value.
Actuarial loss.
Loss.
Yeah, correct. That's how much?
13.12.
13.12.
13.12. So if I want to prepare my statement of profit or loss for the year ended 31st December 2008, I will have my net interest income of how much? This one, this 0.16 here. I will have my current service cost, this 5, and I have my gain on settlement income of how much? 3, this one. And my statement of other comprehensive income for the year ended 2008, I will have my return on plan assets 4.52.
Don't slam that gun.
I will have my actual loss of 13.12. Loss will be in jackets since it's a loss. And I will have assets, I will have my ceiling adjustment. Ceiling adjustment of 1 is a loss also because my assets decreased to 11. Then my statement of financial position as at year ended 31st December 2008, I will have my net defined benefit assets or a surplus of how much? 11. Of course, it will come under my non-current assets. And that's the end of this question. And majorly, that's the end of this topic. So I have to stop here for today. Next week, I will just quickly talk around other long-term benefits and termination benefits. It won't even take me 10 minutes because there's really nothing there. The next week will be going into financial instruments for next week. I will share this note with you. You need to practice, you need to solve these questions yourself first. Then this is your assignment. This practice question here. This one
Yes,
is your
sir.
assignment, which you have to submit. And you know that I've given you as assignment also. You see, our mission here is I'll be giving you a lot of assignments. Because I've seen that I can't repeat so much. Like that last diet, there was a lot of repetition from past questions and like that. So we just have to ensure that at least from 2015 to date, I mean, that's how many years? That's 10 years. You can solve all those questions. Your exam will be a walkover for you. So 2015 to date, let's go and get all questions they have asked on IAS 19. Let's get all questions they have asked on IFRS 2, all the topics we have done so far. Let's get all the past questions. Let's solve everything. Don't even wait for me to share with you and give you as assignments. I mean, get to work. Get to work and make your passing fun. When you're accumulating it, it makes it very difficult for you and it becomes very boring and Herculean task. But by the time you're reading I mean, small, little by little, little by little. It makes it fun, and you're enjoying all these stuffs, and you're understanding it very fast. Okay. Let's stop here for today. I have another class by 5 o'clock. Thank you very much. I'll see you
Hello,
next
sir.
time. Yes,
Hello,
Mr.
sir.
Yes, sir.
Please, this note, is it going to be updated on a general note or is it a separate note?
Yeah, I would. Is my working note, right? I
It's not
would.
part of the
It
general note.
is. It is inside, but I will share. The solution is not just there, but I mean, I will share
Okay.
this working note with you. Immediately
Okay.
after the class, I will drop it. I drop it immediately after every class. All
All
right.
right. Thank you.
Bye. See you.